Let's take a conversation forward to talk about markets, the new NFO, where he sees value in this market, and finally, what are the contra bets at a time when Nifty is at an all-time high. Naren, good morning. Fantastic to have you back. Well, what an exciting market this has been, Naren. It has managed to climb perhaps the biggest wall of worry, even the most bullish view, even the Parma bulls would have thought, despite what is happening on inflation, despite what is happening on crude, despite what is happening on the medical front, we are at an all-time high.
Yeah, actually, if you look at it, I think the global central banks proved that they are much more important than anybody else. So I think the amount of money that they pumped in after 2008 has ensured that markets are in good shape. And I believe also that the retail stock market enthusiasm, which has happened after March 2020, and they also started getting interested in stocks at the right time. I think the combination of global central banks and retail interest in stock markets, which started at the right time, I think the combination of the two has led us to this superb equity rally all the way from March 2020. And it continues, and it will continue, I guess, till the time the global central banks want this party to end.
So is it very simple to say, Naren, you're making it sound very simple that till the time global central bankers do not want the party to end, equity markets will outperform? Because we know that global central banks right now are using the word transitory when it comes to inflation. So there is every data point which is pointing to the fact that central bankers do not want the party to end. If they do not want the party to end, will equity markets continue to rise and surge?
Look at the alternatives to an investor today. Interest rates are far too low. So, the reality is it is the global central banks who set interest rates. So if you look at the Western world particularly, you have taken them to zero. I mean, if you talk to all my classmates who are sitting in US, they're saying, what do I do with the money if interest rates are zero? And so it's a trap actually that only the global central banks can solve. It is the global central banks who, if they keep on saying that they're going to raise rates much later and after pumping $25,000 billion. So I don't think it is reality is that it is the global central banks only who can reduce the party, because you have to remember one thing, which we at ICICI keep telling people, that in an inflationary environment, earnings will come. Inflation is one company's output price, and output price goes up, let's say for steel or sugar or copper or oil, earnings is going to come. So you're not going to have such a big problem on earnings like you had in 2013 to 20, where output prices fell. So you're not going to have such a big problem on earnings. You have a situation where the central banks want the party to keep going on. The global central bank wants the party to go on. What is the problem? And you look at Indian situation today, you have credit growth at bottom, so which means things have to improve from here. You have current account deficit, which is low. So India is not fragile like 2013. You have corporate profit to GDP ratio, which is low, which means that has to go up. So you have a capex cycle, which has not yet picked up. So everything, and even Indian central bank has been dovish. So you have everything going locally also. So from that point of view, so clearly it is the central banks who have to spoil the party. And if they don't want to spoil the party, and I don't think there is any way in which the markets can suddenly come down other than some geopolitical war or something like that, which is completely outside the bounds of what we can think about. Otherwise, you have a party going right now. That is the reality. That's why the market keeps going up every month. That is the reality.
So Naren, you are a practitioner of market cycles and you understand it very deeply. Same time last year, there was fear and there was disbelief. Right now, do you think there is excitement and there is complacency, or there is still this left out feeling which will continue to drive this market cycle higher? So whatever central bankers will do, Naren, we have to pay importance to cycle. So where are we in that market cycle right now?
As as an investor of other people's money, I think we have to be much more careful. And I would say that, we went and looked at other all-time highs. We looked at 1999, we looked at 2007 and found that, and even 2017, we found that other all-time highs, what were the mistakes people made? We found that the mistakes that people made was they did not practice asset allocation, which means invest in debt, equity, and other asset classes. That was one mistake. The second mistake people made in all those all-time highs was they chose that narrow field in which money was being made, which is in 1999, it was TMT, that is technology, media, and telecom stocks. In 2007, it was infrastructure stocks. In 2017, it was small cap stocks. So we said that was the second mistake that people made. So we said, well, how can we address it at this point of time? So we came to a conclusion. What you can do is always recommend asset allocation, which is invest in equity, debt, and gold. And second is do an investment in everything, not just a narrow area. Because if you invest in a narrow area, there are a lot of risks. And that is what we came up with by looking at the past. Having said that, I would say investing at all-time high is much more, it requires much more caution. That too, when you're investing other people's money, than when you're investing in March 2020, when markets are going down 10% a day. At that time, you can talk with gay abandon, invest today. Today, even if people give us money, we have to invest very much more carefully, and hopefully we will be able to handle the correct times when US increases interest rates. We are actually cautious. That is what we're hoping for. That is what we are thinking.
Naren, you're a top-down investor. For a top-down investor, how's the picture looking like? Because a lot of reflation trade is already played out, which is the comeback in commodities, the comeback in metals, the normalization of the so-called PSU stocks. How is a top-down investor like you investing?
See, the top-down investor has very little problem, if you ask me. So if you look at what is happening in the recent past, you will find that there are a number of small caps and mid caps which are going up every day in a very, very fast way. If you look at some of the stocks which are there, which have very good long-term view, like we can see some sectors like, for example, telecom, some stocks in auto, some stocks in financial services. Those stocks have not been moving. So, and this was the other interesting thing which we saw in all-time highs. In all-time highs in 1999, there were a number of quality stocks which stopped doing well. In 2007, there were a number of quality stocks which stopped doing well. Again, today, if you look at it, there are a number of quality stocks which have stopped doing well. So actually, frankly, from a top-down investor point of view, what we are finding is that there are a number of stocks which have just stopped doing well. And those quality stocks can always be invested at this point of time. And you may not get return in the near term because they are not the ones which are moving. It is these many of these small caps and mid caps which are moving up each day. But from a long-term point of view, there is no problem at this point of time. We can see many stocks which have just not moved in the last 1 year, which are the quality companies in some of the sectors like telecom, financial services, etc.
Stocks like Coal India, NTPC, Power Grid, they really tested your patience. Now these stocks are making a comeback. Do you think some of these so-called value or PSU stocks, which earlier nobody liked them and they were called the ugly ducklings, do you think they have a long way to go? Because we've had 7-8 years of perhaps no return from an SBI or an NTPC, or for that matter, a lot of PSU names.
I think, the word that you associated with some of them is unfair to them, because without them, you won't be able to have electricity in this country. And the reality is, yes, there are concerns of global warming, which we have to be very conscious about. And many of these companies are going into renewable in a massive way to take care of the global warming challenges at this point of time. But the reality is that, 1 year back, for example, one of the reasons people used to tell us that, consumer durable will do well, but they don't require metals to make. But you look at how metals suddenly took off in the last 1 year. So what we have learned over a period of time is to stay disciplined and look at valuations relative to intrinsic value. And, there were groups in the country where people did not believe in, and where we were very clear that many of those groups actually had seen a lot of improvement in the way corporate capital allocation had changed. And we had bet on them because they had done badly for years. So I would say, these kind of things, when you do, eventually you get returns. It is just that you have to be a bit patient. And what we believe is that such models work rather than buying stocks where everything is looking very, very good and the past returns are fantastic and the valuations are very, very high. And we have seen that dramatic turnaround after October, and that turnaround, I think, has years to play out. It is just that we have to continue to be patient. And that is the framework that has helped us over the last 20 years of our existence. So we ask ourselves why it should not play out from here on also. That is how we think about it at this point of time.
Talk about your new NFO extensively, but before that, I just want to understand your thoughts on a sector which over the years I've seen that you have a very deep understanding of metals. Your ability to buy metals at the peak of panic and sell them at peak of excitement is quite extraordinary. Where are metal stocks in terms of, where are metal prices in terms of a cycle? Demand supply, do you think is going to remain favorable for the producers for next couple of years?
It's it's more complex at this point of time because, one of our frameworks is that if anything gives you a triple-digit return, you don't come on big channels like ET Now and then over-glorify that returns. So that is the challenge at this point of time. Otherwise, the sector is fine even today. There are very few players. And you've had a downturn which lasted a long period of time. And based on what we have read, if you have very, very few players in any sector, the sector can do well. And that is the situation. Having said that, it's a very China-sensitive sector. If China starts sneezing, the sector starts going down. That is the only problem in that sector. So, if you're a person who gets scared when there are news items coming from China, then you tend to lose money in that sector. So I believe you should have a weightage in that sector in your portfolio, which gives you peace of mind. The sector looks good, but you should have only that much weightage in your portfolio, which gives you peace of mind. That is how we look at it. Otherwise, the sector is still attractive. Both the non-ferrous and the ferrous, both are interesting, but you should have, in our opinion, limited weightages from a risk management perspective, rather than say, but there are, iron ore, for example, has gone up substantially. And there are interesting situation in the entire metal space. You have some pieces called decarbonization. And in that decarbonization, what happens is instead of oil being spent to run automobiles, you have a lot of metal spent to create electric vehicles. So due to that, a lot of metals is going to see huge boom. So it's very interesting actually. And how the whole decarbonization plays out is going to be one of the very interesting things over the next 3 to 5 years, which we are going to watch. So I would say that, the cheapest, most contrarian part of the return has been made. And now, the less contrarian, more growth-oriented part of the return is to be made. And that is what I feel at this point of time. Whereas if you look at areas like oil, for example, areas like, utilities, look at areas like, telecom, there are so many other areas where still the contrarian parts of it is still very much there for you to play out at this point of time. That is how we look at it at ICICI Prudential.
When you say energy, Naren, I want to understand that one side we are talking about clean fuel, electric vehicles. Reliance is now talking about moving towards clean fuel with a 60,000 crore commitment. Then what is the incentive to buy into oil and gas companies when we know that a disruption is coming, and when markets know that something is going to be out of fashion, then the P multiples will compress?
The challenge is many of these P multiples are compressed. The reality is when your P multiple has already compressed to 4 or 5 or 6, what it means is you're already compressed it to 5. If you have already compressed it to 5 or 6 in many of the sectors, what it means is you're saying that the sector will not last too many years. So that also leads you to some dichotomies at various points of time. And that I found very interesting. That at times what happens is, people in their eagerness to throw out sectors sometimes end up estimating the speed of transition also at times. And that is how I feel that gives you a lot of opportunities. And that is how, you get these greed and fear moments, and that gives you a lot of opportunities, as you well know.
Naren, how excited are you about these internet companies which are going public? When I say internet companies, it could be Zomato, it could be Paytm. Now, a traditional value investor like S Naren would say they are expensive. I don't understand these businesses. Equity is about buying future cash flow, and these companies do not generate cash flow. But there is so much of action and attention and the market cap which is going to get created, that can a fund like yours afford to ignore them?
No, as a fund house, we can just not afford to ignore many growth areas. And as a fund house, we are not a niche fund house. We are a fund house which has to look at all opportunities. I come from the contrarian special situation area, and therefore I find it sometimes difficult. But in my company, there are many people who are better equipped to look at internet and those kind of areas. So they find many of these companies very interesting to look at. And I think, many of these products we use as customers. So it's very interesting. Some of these companies, whether they'll make money or not, some of these companies will make money. So that's the challenge that we have to do much better work. It's a very interesting period because we are not used to dealing with companies which don't make earnings. So these are companies which don't currently make earnings, but they're going to make earnings, and they have phenomenal business models over the next 3 to 5 years. It's a very interesting period, I must say. And frankly, I am grappling with it. But as a house, if you ask me, there are a lot of people. And in my team, I have a number of younger analysts also who find all these things much more interesting to work on. So we've given them the job of looking at some of these areas, and I found it very interesting to work with them in these things.
Let me quote Howard Marks. With S Naren, we always have to quote Howard Marks. One of my favorite quote of Howard Marks is that what smart guys do in the beginning, fools do in the end. So what do you think smart guys are doing right now, and what do you think one should avoid, and what do you think fools and Janta is doing?
So, as a house, if you look at it, we have believed a lot that at this point of the market, you should have money, you should raise money in flexible funds. And that's why what we did was we are launching this FlexiCap NFO, which has the potential to invest in large, mid, small. It has the flexibility to use derivatives up to 45% of the scheme. And we thought that, at this point of time, you actually need asset allocation strategies, or you need funds which have a lot of flexibility, considering that the next few years is going to be dominated by what happens in global markets, thanks to the Fed, etc. And we said that that's what we should do. We should have flexibility and hope that we manage the flexibility well. That challenge still remains, whether we manage that flexibility well. But we said that we should focus on that area, and that's what we should do from as a house at ICICI Prudential, because in 2017 we used to come and tell on on your channel that don't look at small cap and mid cap. That was what we were trying to tell at that point of time. Now what we tell people is that you have to invest in strategies which are flexible, like the flexi cap kind of strategies. Because what we feel is that it is impossible to predict when the Fed is really going to tighten. Until that point of time, the party is on, and there are going to be challenges as and when they tighten. So we will try what we can do, and we hope we will be able to do things in the right way. There's no guarantees, as correctly as SEBI is said. And because the challenge is that we are in an increasing interest rate cycle over the next 3 years. So there are no easy. Earlier, in 2017, 18, 19, we used to tell people invest in debt. But that kind of an opportunity is not easy at this point of time because we are in interest rate rising cycle, which is why, more or less we have been forced, despite SEBI riskometers being different, to look at categories like equity savings and arbitrage at this point of time. So that's what we've been trying to tell people. And we always tell people that at this point of time, if you're trading directly in the market, be very disciplined. If you having been a stockbroker for 10 years in my life, I always tell people whenever I'm talking in ET now, that if you are a direct investor in equity at this point of time, if you're not disciplined, a lot of the money you make in a bull market, you lose in the ensuing bear market. And markets always go through these cycles. And that is my earnest request, because I've spent 10 years as a stockbroker and it's not been the most pleasant in the bear market. It was extremely pleasant in the bull market of 94, 95 and the bull market of 99, 2000. But I didn't enjoy the bear market that followed as a stockbroker. And that's my earnest request to all direct investors, that please be disciplined. Otherwise, choose mutual funds and choose flexible products in mutual funds or asset allocation products. That's what I tell people all the time, because that's the reality. Because the next 3 years are going to be very, very difficult, in my opinion. 2004 to 7 and 2014 to 17 were easy. 2010 to 13 and 2020 to 23 are not going to be easy. That's the way I look at it.
Okay, that's a very honest, comment. Fund managers rarely talk so frankly. When you said period would be difficult, are you expecting a lot of volatility, or are you expecting the market to reorient itself? Which is they suddenly will start rotating.
The reality is the Indian business cycle is in the initial stages. And you've not had credit growth, you've not had a capex cycle, corporate profits are comfortable. Everything is comfortable. But you have a US business cycle where there's so much of stimulus which has been put both fiscally and monetary policy wise. So what has happened is, you really worry. And when we thought about the last 30 years, we found that at all points of time, corrections have happened due to global reasons, whether it is the Asian financial crisis, the global financial crisis, the internet bust. So what we've seen is, whether we like it or not, we have seen corrections due to global reasons. So this is what worries us, that all of a sudden there will be a correction due to global reasons and people will ask us questions, why did it happen? And the reality will tell you is it happened due to global reasons. And people will ask us, did you not know? And the fact is we don't know, because when will Fed increase interest rates and spoil the party? It's not a question we have an answer. And that's the reason we believe in asset allocation and we believe in flexible equity funds at this point of time. And this is the challenge that all investors are going to face, whether they trade directly in equity or they trade through mutual funds. This is the challenge that investors will have to face.
Well, Naren, always a pleasure to have you back. We've covered a range of topics, from the new NFO in terms of flexibility to your view on metals to where and you see the macro is headed. So stay safe, my friend, and certainly hope to see much more of you.
Thank you. Thank you very much.